Hi guys, hope you're all doing okay. I am coming at you today with a exam to review session. Very exciting stuff. So without further ado, let's get to the review session. Chapter 5. This slide just has a little thing to keep in mind with respect to assertions. And one thing to keep in mind with respect to assertions is just to think about what we as auditors are generally most concerned about when it comes to intentional misstatements, because you do see a lot of questions around this and questions that basically come back to these sorts of principles. So remember, with respect to revenues and assets, we're generally most concerned with intentional overstatement. And so that's why we focus a lot of tests around existence occurrence. Similarly, we are most worried for the expense and liability counts about intentional understatement, so we spend more time testing for completeness, right? We're worried they haven't recorded stuff that they should have. Now, this is all for for-profit companies. In non-for-profit world, we said it's flip-flopped, so we expect them in a non-for-profit to try to overstate the expenses and liabilities and understate the revenues and assets. You would be more worried about existence occurrence for your expenses and liabilities side and completeness for your revenues and assets side. So starting off with the first question, it is about reliability of evidence. And evidence is reliable if what? Kind of starting off with a softball question. So hopefully you got A, which is signals the true state of management's assertions. These two are more about relevance of evidence rather than reliability. So if you go back to those chapter 5 slides, you'll notice there's this whole relevance versus reliability discussion. All right, D, being consistent with management's assertions isn't necessarily a good thing if it's not also truthful, right? Because I can have evidence that's consistent with assertions, but it's bad evidence, right? Falsified evidence. So I prefer evidence that signals the true state, whether it's consistent or inconsistent, right? Because above all, I want to know the truth. Okay, your audit client is under intense pressure to meet an earnings target. Which of the following assertions for sales are you most concerned with? All right, and this goes back to kind of the key risks that we talked about on that earlier slide. So we know for sales, we're going to be most concerned with occurrence. Had the question asked about something like COGS, then it would have been B, completeness. Which of the following best describes the primary purpose of audit procedures? Hopefully you got C, to gather corroborative evidence about management's assertions. In terms of A, obviously the big issue here is this word all, right? Detecting all errors or fraudulent activities. Really, material would be a better answer here. B, to comply with GAAP. Okay, first of all, audit procedures really should be more, we're worried about compliance with GAS, right? Management needs their financial statements to be in compliance with GAAP. We need our procedures to be in compliance with GAS. However, even if this answer B said GAS, that is not the primary purpose of audit procedures, right? The primary purpose or point of audit procedures is not to be in compliance with regulations, right? Audit procedures don't live to be in compliance with regulations, right? They're trying to gather evidence about assertions so I can issue my opinion. It is good to be in accordance with regulations. I should also be in accordance with regulations, but that's kind of just a given. It is not the primary purpose of an audit procedure, right? It's more of a given background thing. And D, verify accuracy of balance sheet. That is really one assertion. And technically for balance sheet, it should be valuation, not accuracy, if we're being a stickler. But yeah, this is just one assertion among many, whereas C is a much more general answer. It's saying, hey, I want to gather evidence about all assertions. So C is definitely our best answer here. All right, 4, an auditor concluded that no excessive costs for an idle plant were charged to inventory. The conclusion most likely related to the auditor's objective to obtain evidence about the financial statement assertions regarding inventory, particularly ... Okay, so this is a valuation and allocation question. And this type of question where you have this scenario laid out, you're supposed to say what assertion it relates to. And this type of question, number 2, these questions are very classic. You will definitely see some on the CPA. I would say you'd see a lot on the CPA. And these are questions people typically tend to struggle with. So it's good for us to get lots and lots of practice on these. All right, so in terms of valuation, sometimes people will struggle with this because they're like, okay, we're talking about whether excessive costs were charged or not. That sounds like I care about whether inventory was overstated versus understated. So I'm thinking existence completeness, right? No, this is really not about the quantity of inventory being overstated, understated, recorded. It's really about the costing of inventory, right? The valuation of the inventory that's there, not the quantity of inventory that's there. So this is very much a typical valuation scenario, whereas completeness would be more particular inventory items that should be recorded are not. Existence would be, hey, these items have been recorded. These particular items have been recorded when they shouldn't be. Rights and obligations questions around inventory, we said before, usually deal with things like consignment inventory. All right, so if you see questions, and especially inventory related questions around costing, and they're typically going to be valuation and allocation assertion questions. So I had one in a much older exam that said something like, okay, during the inventory observation, the auditor went around the warehouse and they noticed like this area where all the inventory looked like it hadn't been touched in years and it was covered in a layer of dust. Right? And so which, assertion is management at risk for violating? And that was also an example of this valuation assertion, because the idea is, hey, that inventory, clearly nobody has bought it in years. Nobody is interested in those products. So they're likely obsolete. And if they are valued on the balance sheet at full value, then, full cost value, then their market value is probably far below cost in this case. And they should really be written down. There should be some kind of reserve against these items. And this, again, is another super classic type of question you'll see, which is another kind of existence completeness question. At its core, it's an existence versus completeness question. And do you know the difference between existence versus completeness? Okay, so the question says, if the objective of a test of details is to detect overstatement of sales, the auditor should trace transactions from what to what? All right, so the key to this question is you're trying to detect overstatement, all right? So that means my objective is to test existence. We know that. Now, a flaw to this question, which this is an actual old CPA exam question. Okay, I did not write this question, but a flaw to this question is the use of the word trace is misleading here, because we talked about how typically you vouch something in tests of existence and you trace things in tests of completeness, right? And we talked about the definitions of vouch and trace, and I told you it's highly reliable. If you see vouch in a question, you can usually count on the question to be about existence. If you see trace in a question, you can usually count on the question to be about completeness. And the other thing I told you, and really the textbook told you this as well, is the definitions of vouch and trace, right? Which that's what is key here. Because the definition of vouch is that you're directionally going from accounting records to source documents, and the definition of trace is technically that you're going from the source documents to the accounting records. Now, this question, which is a CPA question, like I said, is using the word trace improperly here. Technically, really should be using the word vouch. But they use the word trace, which sometimes they do. But what you can count on really in this question is, hey, the whole point of this test is to try to detect overstatement. That is a clear test of existence. So even though they're using this verb improperly, I can still count on the fact that, hey, at the core of this question, I'm doing a test of existence. So if I'm doing a test of existence, I know directionally, I am worried there are things recorded in the company's records, on the company's books, that don't exist. And if I think the company has recorded stuff on its books that don't exist, I need to test directionally from the records or books where I think the stuff is recorded that doesn't exist out to source documents, right? So it needs to directionally go like this, which we said is the definition of vouching. I have that on this next slide, right? I say overstatements, aka a test of existence occurrence. And I'm doing this because I'm worried they recorded stuff that doesn't exist. This direction of testing, whenever I'm going to the source documents and I'm going back into the accounting records, this is technically tracing, and it is a test of completeness. And C and D, generally, when you're agreeing or reconciling general ledger to subledger accounts, that is usually describing some kind of a test of completeness. I think we had an example back in chapter 5 for the AR test of completeness when we were reconciling the AR subledger to the general ledger. So moving on to chapter 6, questions. Internal controls are not designed to provide reasonable assurance that, okay, this is kind of an easier question for us. So hopefully you read B, and the main problem with B is it sounds way too extreme as an answer, right? Embezzlement will be completely eliminated, as opposed to, hey, good controls should reduce risk of embezzlement, right? This is really saying eliminated, as in 100% gone. So wording is way too strong here, where as the rest are saying transactions, I'm providing reasonable assurance that transactions are being executed with management's authorization, that access to assets is permitted only in accordance with authorization. So these are both focused on authorization. And this is sort of saying, hey, they do reconciliations in a timely manner. So these are all kind of reasonable sounding. This is kind of unreasonable sounding. An auditor would most likely be concerned with internal control policies and procedures that provide reasonable assurance about. The key to this question is it asks what an auditor is most interested in. Right? And remember that auditors are interested in ICFR, where the FR stands for financial reporting, right? And we talked about how, okay, management has controls over operations, compliance, and financial reporting that they're responsible for, right? The auditor cares about these controls, the financial reporting controls. When you're going through and reading through these are really efficiency of decision-making that's operational, right? Making sure the prices they charge are appropriate, that's really operational. And making sure they have a good way of assigning production tasks to people, that's really operational, right? So none of those have anything to do with financial reporting. That's what this relates to. So in terms of what an auditor is actually going to care about, it is D. Okay. The purpose of test of controls is to determine that, hopefully you got A, that internal control policies and procedures are operating as designed. This is a nice benefit of test of controls. If controls are effective, then we can have fewer substantive procedures, but it's not the purpose of TOC. And in terms of errors and irregularities are prevented and detected in a timely manner, that's really the purpose of controls, not the purpose of test of controls. I think C is usually the one that causes the most confusion. Students are usually like A versus C, and the auditor has an understanding of internal control. The auditor is required to gain an understanding of internal control, but that should happen before test of controls, right? It's a whole separate process. This is going to happen as part of risk assessment, right? They have to gain the understanding of the control environment in order to do the initial assessment of control risk. Okay, effective internal control helps to mitigate risks that threaten the company's objectives. Hopefully this is the one you got. In terms of our wrong answers here, okay, they are all way too extreme. Again, this is kind of like I read these answers and I'm like, okay, which of these ones is not like the others, right? So B is saying eliminates risk and potential loss, okay? This word implies 100% is gone. Cannot be circumvented by management, okay? Like impossible for management to bypass. No, like no system of internal control is ever going to be perfect. We saw that when we were talking through chapter 6. We were like, no matter how hard you try, there's always the chance that management can override things. Is unaffected by changing circumstances and conditions. Okay, that sounds ridiculous, right? Can we imagine any system of internal control that is going to remain unaffected by, external systems changing? So these are all very, very extreme answers. This is totally reasonable, right? Oh, it's helping to mitigate risks that threaten the company's objectives. Alrighty, chapter 7. All right, SOX requires management to include a report on internal control in the firm's annual report. Okay, this refers to 404A, right? Also requires auditors to evaluate management's internal control report. Sounds like 404B. Which of the following statements concerning these requirements is false? So the auditors should provide recommendations for improving internal control in their assessment. So the key to why A is false is this. So we're not providing recommendations in our assessment or for B report. We do ultimately provide management some recommendations for internal control in something called management letter comments, or MLCs. We'll talk about that in chapter 17, but that is not something we have discussed yet at all, so it should not sound familiar to you. Okay. B, management should identify significant deficiencies and material weaknesses in its report. We know they have to identify MWs because those have to be publicly disclosed, but significant deficiencies only have to go to the audit committee, right? Only have to be reported to the audit committee. They do not have to be reported to shareholders. So if significant deficiencies wasn't included in B, B would be okay, but since it is included, B is also false. So A is false, B is false. Management's report should state its responsibility for establishing and maintaining adequate internal controls. Yes, we saw that in all the examples we walked through together, all those Apple examples. And auditors should evaluate whether internal controls are effective in accurately and fairly reflecting the firm's transactions. Yes, we saw that too. Okay, so it is E. All right, one thing I want to tell you, and you'll notice this in the next couple questions, don't be surprised if on the exam you do see some questions that have more than just A through E, right? And have some multi-choice answers and some none of the aboves and some all of the aboves. So you got to make sure you are reading carefully through all of these options. All right, yeah, so our answer was E. S&H Associates has just performed an ICFR audit of Bob's Bikes, an accelerated filer. S&H was unable to obtain a written representation from management about internal control. Which the following is true? All right, we talked about this specific situation. It was really the only example we had of what? Of a scope limitation, of a more than minor scope limitation specifically. Remember, because we had the minor, in which case you still get a unqualified opinion for ICFR, and then we had the more than minor, which leads you to the disclaimer. So this is going to be a limitation on scope. This is going to cause a disclaimer, which ultimately is going to lead me to answer G. Which of the following is not true? Okay, AKA, which of the following is false? If you want to reword the question, a big part of why this question is hard is there are some double negatives throughout, or just negative language throughout, right? Which of the following is not true? And then it uses words throughout, like not communicate, not include, no significant, right? So that is a big part of what makes this question confusing, is there is just confusing language throughout the question. Right? So if you want to kind of scratch stuff out and reword it, that would be my recommendation to make sure you don't get confused. All right. So it's basically a true false. So which one of these is false? Okay. The auditor should not communicate any discovered control deficiencies to management until the audit of internal control is finished. All right, that is not true. Okay, so this is a false, right? Because we said, Okay, they should be communicating with management kind of continuously about control deficiencies they are discovering along the way. It would be kind of ridiculous if you waited to the end and then kind of overloaded management with all the information. That would lead to a very poor auditor-client relationship. Okay. This one, written communication, about written communication, I don't think we talked about this explicitly, but if you read your textbook, which hopefully you did, you would see it's true. And the auditor should not include. Okay, C, I think, is the worst answer to read through because of these two negatives. So the auditor should not include in the report that no significant deficiencies were noted during an audit of internal control over financial reporting. That is true because they should not be referring to significant deficiencies at all in their report. Okay. The only thing they would want to mention in their report would be material weaknesses. So the only thing I should be including is references to material weaknesses. So I should not say anything. I should not include that there were significant deficiencies. I should not include that there were not significant deficiencies. Basically, I should not mention them at all, either way. D, if fraud is discovered, I must report it to the appropriate level of management. We know this to be true, right? And then E is just a distractor answer to try to make this whole question more confusing and difficult. Okay, so this leaves me with A as my answer. 13 is a service organization processes payroll data having a material effect on the financial statements of an audit client. The client has established certain internal controls over input and output data. If the user auditor intends to rely on the operating effectiveness of the service organization's controls, which of the following statements is false? Okay, so remember we had like one slide on service organizations. I think it's at the end of chapter 6. In terms of where this discussion is in your textbook, I think it's actually an advanced module at the end of chapter 7. Definitely check it out. And remember, service organizations are things like ADP for payroll. So since this is a payroll example, kind of think of them in your mind as you're reading this question. And hopefully you got D, which of these is false, right? So reading through D, if certain relevant controls exist only at the service organization, so this is our ADP, and a service auditor issues a report, meaning an auditor of ADP, issues a report only on the design of controls. So this would be the type 1 report we talked about. The user auditor, so this means the auditor of the client here, right? Not the auditor of ADP. The user auditor may use that report as a basis for reliance on the controls. We know that is patently false because we said the only report they can use as a basis for reliance is the type 2 report, which tells you not only about the design of controls, but also about the operating effectiveness of controls, which is really the key thing that you need to know about in order to lower control risk below max for controls of a service provider. Okay, so D is very, very obviously false when you read through. The main other option people generally get confused about is A. So I want to talk about A for a second, and I've added this verbiage in green, so the green words were not there. So what A said was the user auditor may decide that obtaining evidence of operating effectiveness of the service organization's controls is not necessary or efficient and still be able to rely on those controls. So the reason why people struggled with this is the language of this answer makes it sound like the auditor is okay with basically not getting any evidence that the controls are effective, right? And then saying, oh, but control risk is low, I'm not doing any substantive testing. Really what this is trying to say is they're not personally going out and testing those controls, and they would still be able to rely on it by getting the type 2 report, right? And you're supposed to kind of be able to discern that or infer that by comparing this answer to the other answer choices here. But what people really don't like about this answer, as a kind of just looking at the answer standing alone, is, and I think this is a very fair point, is it says basically that they don't need to obtain evidence. And you could definitely say the type 2 report is evidence, right? I mean, that is the auditor getting evidence that the controls are working. That's the whole point of the type 2 report. So I do understand where people are coming from if you picked A, but when you compare it to these other answers, D is so clearly wrong that it is the best answer, whereas A is a bit more open to interpretation, especially when you're reading through these other answer choices. Now, I still don't love it. I still think A could have been better worded if, for instance, the word directly had been inserted, been much more clear, but there we have it. So remember just to always go with your best answer. Okay, chapter 8. Performing a sampling for TOC with a population size of 1,000 and sample size of 20. You determine that you will use systematic selection in order to select items for testing. What sampling interval do you use? Okay, this was a very straightforward one. And we went through that example of systematic selection versus random selection in class. So hopefully you got this one. If you didn't, go back through that chapter 8 lecture and you will see, because this is there's no tricks to this one. It's really straightforward. If auditors conducting attribute sampling found that the entity deviated from a control in 9 of the first 10 items examined, the auditor is most likely to what? All right, this one is D, and it is stop the test and increase control risk, right? And again, this was specifically kind of called out on the chapter 8 slides that we just did. And so the idea is, okay, if it has already failed 90% of the time, right, 90% fail rate in my first 10 items I test, there's no way, like my tolerable error rate for the test, let's say it is probably 10% or something like that. So I'm already so far in excess of it. And it's unlikely if I continue to test, right, how many items do you possibly have? 25, 50? You're not going to get below that 10% tolerable error rate. So go ahead and save yourself the rest of the effort, and you can stop testing there and go ahead and conclude that the control is ineffective, increase control risk, decrease detection risk, and increase your level of substantive testing for the associated process and account. Which of the following statements is false? So we've got a lot of statements to read through here. Hopefully when you read through all of them, you saw C was the false statement. So A is purely definitional, very straightforward. Confidence level is the complement of sampling risk. Yep, we talked about how they both add up to 100, right? And we talked about how non-statistical sampling auditors, right, infusing their judgment into the sampling program. All right, so let's talk about C and how I can reword C to make it true. Okay, so C currently says the larger the sample, the lower the confidence level, and the lower the sampling risk. All right, remember your confidence level drives your sample, not the other way around, right? So confidence level should be first in this question. I can say the lower my confidence level, the higher my sampling risk, right? Because we know as confidence level goes down, say from 95 to 90, that means my sampling risk is going to go up, say from 5 to 10, because they're complements. So the lower my confidence level, the higher my sampling risk, and the smaller my sample size, right? Because we did talk about how confidence level has the direct impact on sample size. So the less confident you're willing to be, you could say, in your result, that your sample is representative, the smaller your sample can be. The more confident I want to be that I have a representative sample, the larger my sample needs to be, right? And if I want to be 100% confident, then I need to test 100% of the population. And then I'm going to have the biggest sample of all. In addition to evaluating the frequency of deviations in tests of controls, an auditor should also consider certain qualitative aspects of the deviations. The auditor most likely would give broader consideration to the implications of the deviation if it was, so the answer here is D. I don't think ever people are confused about this one. I think you guys are always like solid on the fact that this should be D. So the idea is, okay, if it's the only deviation, no big deal there. If it's identical to a deviation last year, it's not great because it kind of indicates they haven't fixed the problem, but it doesn't necessarily indicate anything shady or illegal is going on. It kind of is more consistent with incompetence, right? Or just they don't care. So these things aren't great, but there's always going to be a little bit of this in every organization, right? Nobody's perfect. Whereas this kind of implies, okay, fraud is afoot, so this qualitatively is going to raise a little bit of a red flag for me. Okay, last one. If the expected deviation rate exceeds tolerable deviation rate, the auditor is most likely to, hopefully you got B. Okay, and this is one that I briefly talked about in the Chapter 8 lecture. Okay, so your expected rate should never, ever exceed your tolerable, sorry, that was supposed to be a T, not an F, should never, ever exceed your tolerable deviation rate, okay? That is not a scenario that should ever exist, because if your expected deviation rate exceeds your tolerable deviation rate, basically what you're saying is, I am going into this control test expecting this control to fail, right? You would not want to go into a control test expecting the control to fail beforehand. You would want the control to succeed, right? Or expect the control to succeed if you're spending your time testing it. So typically in terms of, expediency and efficiency of the audit, if you expect a control to fail before you start testing, you're just going to set control risk at max and do more substantive work. Now, the only time that this could theoretically happen is we talked about the idea that for public company audits, you are forced to test all the controls, even if you think they're ineffective. And it's because it's really the accelerated filers, because I have to issue a 404B opinion on them. And I can't issue that opinion unless I have truly tested all the controls. So theoretically, there could be a control in an organization where I'm having to issue a 404B opinion, right, an accelerated filer, and I could expect the control to fail and go into the test expecting it to fail and still test it anyway, right? And I guess for those tests, theoretically, your expected deviation rate would exceed your tolerable deviation rate. But what you typically do for those tests is, because you expect the control to fail anyway, you actually assume an error rate of 0 because you want to minimize your sample size. So you assume an error rate of 0, get the smallest sample size possible, and then basically you get something like this, and you go through the first 10, you see it fails 9 times out of 10, and you're like, okay, I can stop testing, right? Because there's no point in having some really high expected deviation rate and pulling in some massive sample and then having it not work anyway. Okay, so hopefully that makes sense. So you would just assume 0, but in reality, we all know it's going to fail. But theoretically, for this chapter, your book does not cover that scenario. It just kind of covers, theoretically, this is the way it should work, right? So in theory, you would never test the control if you expect it to fail beforehand, because it doesn't really make sense. So therefore, the only reason why we would do it is because of regulation, because we're mandated by the government to do so in certain cases. But there's no conceptual reason why you should be doing that. Okay, questions over chapter 9, which we know was all about audit sampling for substantive tests. So the first question is, while performing a substantive test of details during an audit, the auditor determined that the sample results supported the conclusion that the recorded account balance was materially misstated. Testing told us it was misstated, but the true state of the population was not materially misstated. Okay, so this is incorrect rejection. So don't forget that little slide with the kind of decision matrix where it had this way, you're kind of, I think it was this way and this way, you're making the right decision, and one way you have incorrect rejection, one way you have incorrect acceptance. These guys, remember, are relevant to chapter 8. Right, in monetary unit sampling, population size is what? Okay, so we have the dollar balance in the account. That is sounding like a pretty good answer to me. B, the number of items in the account. This sounds like it is true of our old friend attribute sampling in chapter 8, but not monetary unit sampling. Unrelated to sample size, again, we think that's attribute sampling. That's true of, but not true of MUS. Even though it's not, even though we use the sample size tables for MUS sampling, if you think about it, we still, when we're calculating the tolerable error rate and the expected error rate, we are still using the dollar balance, right? Because we have a tolerable error dollar and a population size in dollars, and we're using those things to come up with the tolerable error rate that we then plug into the table. So population size is still being taken into consideration when sample size is being calculated in monetary unit sampling. So it's not totally irrelevant the way it generally is for attribute sampling, unless of course you have very small populations. All right, D, included in the denominator of the formula to determine sample size. Well, one, this seems to be referencing non-statistical sampling. But even in non-statistical sampling, we know it is in the numerator, right? Not the denominator of the formula. So this is wrong either way. So all three of these are wrong. This one's looking good. Question 3. In a monetary unit sample with a sampling interval of 5K, an auditor discovers that a selected accounts receivable with a recorded amount of 10K has an audit amount of 8K. All right, so the recorded amount, right, means book value is 10,000, audited value is 8,000, and the sampling interval is 5,000. If this is the only error discovered by the auditor, what is the projected misstatement? All right, so we know here that the book value of this item in the sample is greater than the sampling interval, right? And we know that when that happens, we are not supposed to do all this magic where we calculate the changing factor, project it over the sampling interval, and multiply it by the misstatement factor, right? Don't have to worry about any of this. If the book value is greater than the sampling interval, what we do is we utilize the actual amount of misstatement, which in this case is $2,000, because we've tested the entire sampling interval and we know the precise amount of error contained in it. And we did not sample, so we don't need to multiply by the misstatement factor, right? So in this case, our answer is C, $2,000. You have been placed in charge of determining the MUS sample size during substantive testing over accounts receivable. Your superior would like a confidence level of 99%. How would this affect your determination of sample size? Right. A says you must use the 99% confidence level statistical sample table we used in class to obtain correct sample size. All right, no such thing exists, right? We had in class together a 90% confidence level sample table. We had a 95% sample table, but we had no such thing as a 99% sample table. So A does not exist, so not a possible answer. B, a lot of work will be required to achieve 99% confidence. This will be reflected by a very large sample size. Yes, that's true. And we know that is why we didn't have in class a 99% sample table, right? We only had 90 and 95 because 99 requires such large sample sizes that they're generally considered inefficiently large, and it's so much work that you generally wouldn't even want to sample. So it's such a large sample size, sampling wouldn't generally be necessary, so there's no point in us even presenting this as a table. So B is looking pretty good, and I'll read on to C. C says 99% confidence level will give you inefficiently large sample size. Okay, so you most likely pursue alternate approach for testing the AR balance. That is also true because it's consistent with what I just said. So that's actually answer D. It says both B and C are correct. Okay, Harvey Jones CPA uses non-statistical sampling to test an account balance. What's the benefit of non-statistical sampling? Okay, so we know that big disadvantage is you can't quantify sampling risk and you can't quantify an upper misstatement limit. But the big advantage with non-statistical sampling is, hey, I can use judgment. I can pick up individually significant items. I can pick up individually risky items. So I'm looking for some kind of answer that says something along these lines. Okay, so A says it provides a means of mathematically measuring sampling risk that result from examining only a part of the data. So A is a true story for statistical sampling, but not for non-statistical sampling, so it's not going to be my answer today. B says it enables the auditor to utilize professional judgment in selecting a sample. This I know to be true for non-statistical sampling, so this is looking pretty good for my answer choice. C says it increases Jones's knowledge of the entity's prescribed procedures and their limitations. Okay, so this may be true of any sample, right? It may be true of a non-statistical sample, it may be true of a statistical sample. There's no reason why non-statistical sampling might increase your knowledge of your auditee's procedures and why they're good and bad more or less than statistical sampling. So C is not a great answer, especially when we have B, which we know is a great answer. D, it is required by generally accepted auditing standards. Okay, no. Number one, that's not a benefit of it. D, it's not required. So GAS, generally accepted auditing standards, allow for both non-statistical and statistical sampling, right? Both are totally fine. So D isn't true. It is allowed by GAS. E is a great distractor answer because E is a true statement, but I wouldn't call it a benefit of non-statistical sampling, right? Because statistical sampling has the exact same quote-unquote benefit. Both are this is just, I would call it a true statement about non-statistical sampling, but I would not call it a benefit of non-statistical sampling relative to statistical sampling, right? Because that's really kind of what's unsaid in this question is what is a benefit of non-statistical sampling relative to statistical sampling? Because otherwise there's no reason why we'd be talking about benefits of non-statistical sampling if we weren't talking about them relative to statistical sampling. So this is very pointless because it's something that is true for both statistical and non-statistical sampling. Okay, so B is definitely our best answer here. It is indeed the right answer.